Hello, I'm almost Mongolian. I'm interviewing the CEO and executive chairman of Voxtur, Gary Yeoman. And yeah, so I'm just gonna go straight into the first question. And first question and most popular question is that can you like reiterate like your earlier prediction that Q4 will be cash flow positive?
It's certainly like there's never ever any guarantees, but it's certainly trending well. I think the major dependency for us is getting blue water on track, and because for the most part, when we bought blue water, we had to borrow 30 million US, and so it's been a bit of a struggle for us in that blue water has had to do some transitioning, which they have. And so we just come off a pretty good September, which is basically double what they were only averaging between $500,000 and $600,000 a month of revenue. And September looked pretty good, in that, was around that million, 1.1. And October looks really, really promising as well. So we're somewhat buoyant that, with, the success of blue water right now, emulates its success for us as a company as a whole.
Yeah. So it looks that way, but no guarantees.
I don't think there's any guarantees in anything. I mean, if you can tell me
Yeah.
what's happening with interest rates, if you can tell me what's happening with the economy, if you can tell me what's happening and how many transactions are going to take place in the real estate market, if you're going to tell me how many defaults or bankruptcies we have, if you can tell me all of that, I think I could probably give you a little bit more definitive answer. The question is that I think the whole world is, not 100% sure on a day-to-day basis of what is happening. And so what we're trying to do is pivot and try to get into as many non-cyclical businesses as we can so that we can have more predictability and certainty for our shareholders.
Yeah. So, and Q3, it's now over. Results are not out, but like, can you say anything like, was it an improvement over the previous quarter?
It was pretty steady. I mean, there was really there's some momentum in some areas, and others, just basically, we're still waiting for contracts and that to be signed. But there's lots of positivity to look forward in our company, that's for sure. But as I think I said before, I expected Q2 and Q3 to be somewhat similar. And obviously we just finished it, but we don't have any of the results finalized yet. And I'm, certainly an annoyance to my CFO because every day I'm, talking to her and trying to get the results. But I don't think it's going to be substantively different, but, I'll know, in the fullness of time shortly.
All right. And the race, it's still open, isn't it?
Pardon me?
Is the race still open?
No, the raise is closed. This raise is closed.
All right. Yeah. Like everybody,
We
thinks it's open.
Well, we wanted to raise 20 million because we felt that would be enough to kind of get us through the hurdles. I mean, we spend an enormous amount of money on our accounting, as everyone realizes, and it's having to reset with a new accounting firm and deal with the disposition of the old accounting firm, and basically almost being held hostage in that, and unless they provided their notes and working notes and that they wouldn't give us unless we agreed to certain conciliations. And so it's been a real challenge. So legal, accounting, have been egregious for us over the last kind of year and a half. And so once we kind of get through to the other side, we'll have a tremendous benefit to us from a cash flow standpoint.
Yeah. All right. So raise is no longer available.
It was disappointing, but
Yeah.
certainly understanding that we got, because as I say, it's probably not prolific times for anyone in the tech space right now, real estate. I mean, we've certainly seen much more abundance with respect to the number of transactions that are taking place. We expected to see more bankruptcies or trending towards bankruptcies, and it just seems like it's steady as she goes. And so that has an opportunity because we built a bankruptcy platform. We were hoping one major lender would be up and running by November. We're not really sure if that's going to happen yet or not. So, and that's, that was a big deal for us. So we'll just have to wait and see.
Do you think this, what you just raised, it's enough to kind of get you to that position where you don't need to raise anymore?
You mean the additional or the ones that the amount that I have now?
The amount you have now.
I can't say a lot. Depends on what's going to happen between now and the end of the year, as far as transactions go.
All right. So,
I think maybe I'll say this, is that we are looking at every opportunity to monetize certain assets, non-strategic assets that we have, and so that could be the difference. And so there's a whole bunch on the table right now, but I've been extremely active in austerity measures in our company, and so we've cut off tremendous amounts of costs, especially corporately and from a technology standpoint, marketing, sales. I mean, we've basically cut everything to the bone as much as we can. So the key is just getting some accelerated movement in some of the areas that we're in will make a difference.
You said earlier you're looking to get to 200 employees. Where are you right now, like in terms of employees?
We're probably about 290.
Yeah, and you're still looking to get to 200.
Ultimately, that would be our goal. Yes, but we're not there yet.
By the year end or the next year? Or...
Yeah, well, we'll certainly. It is our hope. A lot depends on a few things that are happening.
Yeah. So like the costs are coming down a lot even from here.
Of course.
Yeah.
Of course.
All right. Let's see. So you announced the due diligence product in June, and do you have any like numbers, like how much revenue it has generated?
Well, I mean, it's unlimited because we have the only fully digitized product in North America right now. So anyone that are buying loans, whether it's whole loans, whether it's servicing rights, mortgage servicing rights, whether it's scratch and dent, non-qualified loans, if in every case people are buying those loans, need to know what the quality of those loans are. And the reason why is that, Fannie or Freddie, who's ever buying those loans, whatever, institution is buying those loans, they can go back and be turned back if they don't qualify, if there's anomalies in them, if there's things that are not included that should be included. And so it could take a month, 2 months, 3 months, for the purchasers of those loans to be able to synthesize the whole product. And having to sell those loans back or take those loans back can be extremely detrimental from a cost standpoint, especially in servicing rates. So with our product, we can do two things. Number one, we can scrub the whole loan portfolio for the seller. And so they can deliver with certainty whoever's purchasing it. And so we think we can get them a better price because we've scrubbed the loan. And then for those that are purchasing it, historically, all they've done is, check 3 to 5% of those loans because it's costing them $500 on average, to do that review process because it's done manually. Our claim is that we can do a full scrubbing from a digitized standpoint for $25. As a consequence, we could do a whole review of 100% of the loans for less money than what it would cost for them to do 5% manually. And so we do know that, we're getting some momentum on that. And so for the purchaser of that service, they can also have access to an insurance product that is offered to cover it. And the only things that it is not covered by that is basically fraudulent activities or misrepresentation. And so from that standpoint, we can, with respect to the actual loan itself, as long as the information hasn't been fraudulently, misrepresented, we can give them much more certainty with respect to the quality of the product that they're buying. And that is a big difference, especially in today, because with the interest rate so high, everyone is, certainly more vulnerable.
Yeah, but you don't have any like a knowledge about how much the product has already made revenue.
Al Qureshi has probably the biggest pipeline of business that we've ever had. In his, since he started, Blue Water, it's the biggest pipeline that we've had. We have a bigger pipeline than we believe than anyone in the marketplace. We've got, some major clients that he's dealing with right now, and some sub-servicers, some servicers, some, just basically lenders. And so his pipeline is extremely deep. Whether they close, in October or November or December is, basically anyone's guess, because we can't, make something happen. But the pipeline is deep and it's strong, and, things are looking extremely well. The guys have a big mortgage conference in New York in another week. And, that is where a lot of the opportunities are bred. And so they're waiting with bated breath to get to there. They have a full pipeline of meetings already scheduled. And so we're pretty optimistic that we'll be able to, have some advantage there.
All right. The Ontario RPTA deal, what's going on with that?
Yeah, I was hoping you could tell me. Every day we're waiting. Every day that we're told that, first of all, it was announced by the Premier in the province of Ontario, assessment-based product management product will be there. We have been, told by the most senior of staff at the ministry level that the product will be unveiled. And what we haven't been told is that the exact day. It's just, it's on the bus, it's waiting. Everyone wants it. The municipalities absolutely need it. There hasn't been a reassessment in Ontario since 2016, and there's a massive amount of revenue that the municipalities are missing and that they need to be able to focus on. And so we've done all of our work. We're ready to go. We're ready to sign. The contracts have been prepared. And so I'm just, crossing my fingers. And, we had a big issue in the province where there was a whole issue with respect to what they call greenbelt lands being exchanged to zoning. And that has occupied the government's space fairly abundantly. And that, caused a bit of a delay in ours. So I can only tell you what I know. And that, for the last, number of months, we've waited with bated breath. We know what's going to happen. I just can't tell you exactly that day.
Yeah, it's out of your hands.
Well, it is, but it's a big deal for us, because you think about it, it's not only the licensing fees that we get, but once that's available to every municipality in the province, there's 444 municipalities in the province of Ontario. If we got a retainer from every municipality, in addition to the technology fee that the province is paying for, this could be by far our most prolific and one of the highest margin businesses that we have. So it's critical to our success going forward. And so that's why we're, obviously, we have anxiety because it hasn't happened yesterday, and it should have happened yesterday. So we're waiting. We know what's going to happen. We just don't know when.
All right. So you press released, I think June, like top 3 lender or servicer. Bluewater had an exclusive deal with. So like, have you ramped up with that client yet?
No, we're ramping up. Every day we're doing something, and so we're expecting, business is increasing. We're getting clients, but the one provider had sold a portion of their business around the time we bought Blue Water, and so they had to reload and basically update all of the correspondence on their platform. And so they're doing that bit by bit. And so our business is increasing bit by bit, but certainly not back to where it was. And so that's what was one of the reasons why Blue Water fell off, because they lost close to 500,000 a month in revenue that has to be re-implemented.
And this is the client you press released as a top 3
Well,
lender.
that's, I think that we have 3 of the top 6. So, obviously, that we can't tell anybody who it is because we're sworn to confidentiality. But I will say that we are amply represented as far as the top investors in the space.
Yeah. And there was another client you talked about last time, like a client that was prohibited from buying MSRs because of their bank or something like this.
Yeah.
And is that client back?
It's certainly back with us, but they haven't ramped up yet. Where there's been a couple of small deals, but they're just not back to where they are because interest rates, as you know, have tripled, and so the cost of MSRs have went up. It's kind of contrary to what happens with bonds, right? If bond rates go up, the value of the existing bonds that you have go down. In our particular case, with MSRs, if rates go up, then the value of MSRs go up. And so, they have a legislative, or if it's internally, requirement that they can only invest a certain percentage in every category in their business. And with MSRs, they were our best client, and then because of the prices jacking up substantively, more than double, it's caused them to pause, and they're waiting for some changes. So we had a couple of small deals, but not to where we were going. I mean, we still have them as a client. We are front and center with them, and when things settle down or even fall off, then we'll have that opportunity to retool.
All right. Bluewater, you had in the press release, you said it was exclusive deal with TMC, the Bluewater. But when I go to the website, and there's many different providers in that part where it says MSR trading partners. There's Bluewater, there's one, and there's another. Is that I guess the question is, are you gonna be? Does it mean you're gonna be totally exclusive for them? Or?
In our specific products, we are. I mean, we have the only fully digitized product, and so for due diligence, there's no one else, like us, and so that's why. I mean, it's an exclusive club to get into the TMC, and we're thrilled by that. And they brought a few deals, although not substantive yet, but pretty optimistic that will play itself out in the fullness of time.
Right. And I think you mentioned in the last interview there was a 700 million deal on it's like Bluewater competitor that was owned by Black Knight. I don't remember the name actually, but like the what I'm talking about. Um, it was sold for 700 million. It was Blue Water's
Yeah,
competitor. Yeah.
yeah. I think
Yeah.
I don't know if it's so much a competitor, but certainly what Blue Water does, you know, um, you know, certainly we provide, we provide services that aid and abet that platform, and so we're reasonably optimistic that we can do business with everybody. And so I think that everybody knows that ICE has been extremely aggressive in buying everything. There was a bit of a holdup, on the Anti-Competition Bureau and whether they're going to allow that deal to happen, which it did ultimately happen. So, we're of the opinion that we'll be able to work closely with them. We've built our technology to interface with their technology. So, I mean, as far as we're concerned, we're good to go on any of our clients. The interface has been built.
Yeah. So I guess I would for you to compare the competitors of Blue Water to Blue Water, like the Black Knights, MSR
Yeah,
solution, and some of
yeah.
those.
I don't think the Black Knights are really that much of a competitor to us. I think that Black Knight can be a good client of ours in a lot of ways. Black Knight, was a certainly had the platform, for integrating the mortgage services, into the mainstream. And now they've sold that piece to another entity, and that other entity is trying to basically control technology, at right at the main pipe, and basically delivering everything through Fannie and Freddie on their pipe. And so we have our own aspirations, but right now we've integrated um, a piece of technology that we have that integrates with everything, from a mortgage technology provider. We have it. And so that's what we're doing, is continuing to allow our clients to use our platform to basically, get into the main, technology pipe for all mortgages.
Yeah. Next question. So, so you have said you have like many offerings that, like during the summer in interviews, you have said you have many offerings you are kind of going to launch or are launching, and
Right.
you're spending money in them. So, I mean, I would like to kind of for you to tell what are the different offerings, and when you are launching them,
Sure.
what you have launched.
So let's start off with title. So basically we've changed the face of how, we're doing our title. We're doing some outsourcing right now, and we built some technology that allows us to be able to do it, more, certainly more affordably, more accurate, quicker, and we've increased our margins for title. And so, that is underway, and our transitioning, and not being dependent on the law firm, which we formerly were, as far as getting orders in. That was a big deal. And so we're certainly doing business with the law firm, and we have a good relationship with a law. But we're basically establishing our own independent, our own independent title business. And then we're basically building technology pieces to that. So there's three, primarily, or at least two major pieces that we're developing, but I'll get into it right now. The first major piece is that everyone that gets title insurance right now is basically getting insurance to basically say that, the existing title that you have today is basically clean, that there are no charges, there's no liens, there's no encumbrances, on that title. So if you're buying a piece of real estate, you're buying with certainty that real estate that you can own without any, charges or liens against that property. But the day after you sign it, there's no guarantee going forward. So we partnered up with another company that they have built some technology. They're have agreed, and we have an agreement in place that they use our total platform to hit all of the major lenders. And we've talked to every major title provider, and we're in significant discussions right now to basically allow them to use our platform. And so we get paid essentially of the total price. We get about a third of the total revenue coming in, and it's a technology that we've already built and developed for our platform. And so we're real close in a lot of the major title providers that think about this. And I personally bought it myself for my home in Naples. So that's how strongly I feel about it, is that the day after you close, somebody could fraudulently go in there and represent, to the title company that that their name is Gary Yeoman, that they own the house, in Naples, Florida, and blah, blah, blah. They go to the bank and they fraudulently, make some, put some, papers together to provide those institutions that they are somebody that they're not. And you're seeing lots of fraudulent activity taking place in North America right now to that goal. And with this piece of technology that's been developed, there's a three-pronged authenticator that the only way anyone can have access to put any charge against your property has to go through that authenticator process. And right now, that process is, we're in discussions right now to be able to, offer that to every major title provider. And so we're really excited that that those discussions are moving along. We'll hope to see some of that opportunities present itself in the fourth quarter. So that's a major deal. The second major deal is that what we're trying to do is that we're trying to essentially create a fully digitized loan officer. But that comes in steps. One is data. The second is technology to be able to provide what we call starter kits. So right now, to gather information for title, if you're a title, if you're not a title company, but you're a title agent, it costs you about $130 to put together a starter kit. Well, we're able to do it for $50. And so the fact of the matter is that we know that as we're basically proving that technology right now through a pilot project of our own clients. And so far so good. And so at some point in time, later in the fourth quarter, we'll start rolling that out to other title agents. And essentially, if you're able to save yourself $60 on average as a cost providing these starter kits, it's a massive increase in margins for title companies. And so we're really optimistic, so much so that the actual title insurance providers would like this, because they're providing a lot of that information as they go. And so we're really excited about that opportunity. So that's one part of it. And so we're going to continue to keep going right down the line where a fully basically digitized loan officer can save people where the average cost is $3,000. We can knock it down to $1,000. And it's a big deal for us. Now that's going to happen in 2024. But we're just taking it one step at a time. We have one client that we're talking to that pays $130 for a starter kit. They're doing 25,000 transactions a month. And so if we can save them, $70 a transaction, then you can do the math. It's massive amounts of money to the bottom line, and so there's not a title company in the planet Earth that doesn't want that. So we're excited, very excited about that opportunity to offer that starter kit. Again, we're doing that pilot project on our own products first, because obviously once you launch, you can't afford any hiccups whatsoever. So we're really excited about that opportunity. So basically from what we've done, we've offered a data product. Second is the starter kit, and the third is fully digitized. So those are three main things that we're counting on with respect to our title. And then obviously the fourth is what we call basically I can't give the name out because it's another company, but we've got an exclusive for the technology to run it on our pipe. And let's just call it Equity Protect for lack of a better word, but that will be up and running in Q4 as well. So we're excited about that, on our on our title side. On our valuation side, which is a big deal, I think that everybody knows, and Fannie and Freddie both announced it, is that they're going to encourage and accept an alternative to the typical appraisal valuation. So as you know it, and I've talked about it many times, it costs you up to $1,000 an appraisal and takes 20 days. Well, I think that the Fannie and Freddie have acknowledged that in many cases, going through that whole process and taking that time and spending that money makes it very inefficient, not not in all cases needed. And so for everyone on the GSE side, it's about making home ownership more affordable. So essentially what we've done is that we have the Apex, which is the largest sketch database in North America. And we built, a piece of technology where you can go with your iPhone or your iPad and walk into a property right now and, do a fully digitized mobile application that'll update on your device immediately, that you can do a sketch and a floor plan layout. And all you have to do to add to that is that essentially once you have the sketch and the floor plan layout, is to apply an AVM. And in most cases, that the Fannies and Freddie would use their own. But having done that is a major coup. Now, as you know, we recently told everybody that we have been approved by Fannie on our data collection tool. And so having that, there's only, I think, about 6 companies right now in North America or the United States that have been approved by Fannie for their data collection tool. So once you take the data collection tool, along with the floor plan layouts, and along with the sketch, and have it fully digitized with our device, essentially what you can do in 20 minutes and have it uploaded is a massive savings. Now, our cost is negligible. And yet we'll be paid, somewhere between $200 and $225 to do that. And so that's a big deal for us, a massive savings, because you're looking at extremely high margin technology business versus, as you know, some of the valuations that are done before, that even the best valuation companies only get a 10% profit margin business. So you're going to see a massive transition in 2024 to sketches and floor plan layouts from the traditional appraisal. And so we think that we're one of the forerunners and leaders of that. So, a big deal for us on the valuation side. The other major growth for our valuation side is in what we call appraisal direct. So in many cases, there's an abundance of AMCs that are out there right now that all of the lenders go through, and they're the ones that are the air traffic controller that accepts, the appraisal request, coordinates it through their own appraisal panel. And ultimately what you get is your $700 to $1,000 in appraisal, and that's what takes 20 days. And so we built our own platform with one of the largest wholesale lenders, in North America. And essentially what we've done is bypass an AMC. And so we've created their own appraisal panel. We built their own technology so that they can administer their own appraisal management services through that. We have another major client that we hope to add on into the fourth quarter. And so, we're really excited about that because it's a massive opportunity for revenue for us. And, one of the priorities that we have, as a company is to increase, appraisal direct. So a big deal for us. So you'll see us transitioning to appraisal direct and into floor plan layouts and sketches, and it'll be less dependency on what we call the AMC, which is a steady business, a well-run business by Al Broadway of our company, but very low margin profits. It takes a lot of manpower, takes a lot of there's a lot of bureaucracy and licensing and compliance and governance. Legal work's required, accounting work's required. It's just a really bulky, onerous platform. So we want to switch to that. So we've talked about tax, we talked about valuation, we talked about title, and then the last thing is Al Qureshi. And so as most people know, I mean, we think that we've touched all of the buttons now. Al has not only digitized everything, but we now own our own, basically mortgage service provider. So we are able to do excess trades, on our own platform. And so basically we can participate in all aspects of the day of a mortgage or a loan package that is sold in the marketplace. So I call it seed to table. Al has positioned himself now from a technology standpoint that we can fundamentally control all aspects of that deal, from, hedging and pricing, from identifying, who is selling, identifying the buyers, facilitating it on our platform, and providing all of the due diligence, and the coordination of that. So hence Al is now starting to get some traction. He had a decent September. He's going to have a better October. And we're hoping that that momentum is going to continue with the new clients that he's actually, basically the pipeline that we have, that there's, at least 3 major clients that we're hope to border in 2014 or 2023, at least between now and the end of the year. So again, we're really excited. If you've noticed that everything I've talked about, the trend is moving more towards technology and less reliant on high manpower business. Now, having said all that, you can't do all of that without a data platform. And so our Benditech business, which basically runs all of our data, continues to do steady Eddie. They have a lead generation tool for title and real estate agents, a client retention tool that is now being purchased by most of the title insuring product companies right now. So basically all of the major title insurance companies that used to have their own can't compete with what we're doing, and so they're buying it. So you're going to see a nice little uptick, on our data business, but fundamentally it is the grassroots that helps us funnel everything that we need for success in our business. And there you go. Lastly, we've completed building our bankruptcy tool platform under our InfoX, technology group. And quite frankly, we're hoping that in November that's going to initiate. We had one major lender providing us all of the seed capital to build that, to be that major technology provider, save them lots of money and fully digitize the whole bankruptcy process. And I think if I'm talking realistically right now, I think that our eyes were bigger than our stomach. It appears that the bankruptcy and defaults are not going to come on as quick as what, not that we want to wish bankruptcy and default on anyone, but as you know, prices of real estate, have creeped up. And so rather than people, entering into a default or bankruptcy, they will primarily focus on just selling the property and not going through that process because they have enough equity into it. And so I think, over the next 6 months, you're going to see, no question, with the interest rates tripled, um, that what's going to happen is that over the fullness of time, you're going to see defaults and bankruptcy increase, but maybe not as quick as what we'd hoped. So that kind of covers the gambit of what we're doing and why we're excited as far as the new opportunities.
Yeah, a lot of things are happening in fourth quarter.
But yeah, but you have to. I mean, you either forge ahead or you fall back. I think that most companies that have success, if they're going to rest on their laurels, they're all going to wake up one day and find out, holy mackerel, when we had the money and we had the success, we should have reinvested in that, to be able to continue to build. I don't believe that there's another company like us on the planet Earth that has the technology services. Having said that, there's a massive cost, as anyone knows, to building that technology and get adoption. And so, hence, we've been challenged because we've been funding all of the technology. We own all of the technology. We're builders of it, and we've been funding it. And we believe strongly in what we're doing, and that is finally manifesting itself into that profitable business. But it's been a hell of a journey. And I don't think that anyone could have anticipated, a lot of the the slaughtering that has taken place in the marketplace. But here we are, we're still standing. And we think that we've got some monetization of some of our assets that can take place that will essentially mitigate a material amount of our debt. And so therefore, the elephant in the room is keeping, the bank happy. And so I think that we're moving along very closely to realizing some of those opportunities. And, it would be a wonderful position if that we, by the end of 2024 or early 2023, sorry, or early 2024, that we basically eliminated a good portion of our debt. And so that's kind of what our goal is, and that still stays strong. And I think that will make the bank very happy as well.
Yeah, about the debt, I got one person contacted me. He was worried about the comment you made in the last interview about like considering convertible debt. And there's a term, convertible debt spiral. Like, so I don't know. Could you comment more? Like, are you seriously considering?
Yeah, we first of all, we didn't do the convertible debt like we were contemplating it, and the last raise 11.7 was in equity, right, for the most part. So we stayed away from the convert. There's lots of offerings right now for us to be able to provide us money in the form of a convertible debenture, but it comes with a lot of risk. As when you enter into those kind of facilities, there's opportunities where people can come in and basically short your stock and bring it down. And so the less amount of us participating in those type of offerings is certainly not attractive for the shareholders, and certainly not attractive for us. I mean, it's kind of like the last resort. I mean, if your profits are just soaring and everything is just like, taking off, then I think that risk is substantially mitigated. But as you're waiting for a lot of these products to get started and get some flight to them, then it becomes a little bit risky. And so us getting into convertible debentures right now is not our first choice.
All right. Yeah, I mean that's the sentiment right now is a lot of people are bullish long term, but are worried that short term things are gonna happen that are gonna take away from their share of the
Well,
company.
which is why, you know, that we are very mindful that with some of the assets that we view as non-strategic, that we enter into some kind of opportunity for monetization of those assets, and with that, and we mitigate the debt. And if we become cash flow positive, then I think that we've got a real nice, sight line with respect to, you know, how we do things. And so the risk, all right, is, getting that monetization done in a timely way. The risk is, getting these new contracts and these new service offerings online to fund the existing business that we have. And so therein lies a risk that falls with every major business. But I think that, what we've done has been extremely intelligent, and I think it's going to bid positively for us. And just lots of excitement to take place in the fourth quarter of 2023.
Yeah. One thing you mentioned earlier, like Blue Water was making 600,000 before September, and like Q2, the technology revenue had almost doubled year over year, and people naturally thought that that was Blue Water, but now that you said it was making only 600, so I guess my question is, were you moving some things from the other things into the technology, or has there
Yeah.
been a strong growth in the technology?
The technology is, falls under a number of different categories, right? But I think that, how we categorize it, I think it's really, really important. And one of the things that we want to do in 2024 is to give, the shareholders better insight on each of our business units, and, look at the cost of doing business, what the gross margins are, what the profit margins are, what is included in technology, what is not included in technology. And so we need to do a much, much better job for our shareholders to be able to, instead of having to be detectives and, read between the lines, we need to do a better job as to defining each of our business units and having our investors ascertain how they look as far as profit margins and gross margins. And so, what's included in technology and what is not. So we're going to do a better job of that in 2024. As you know, we've had to, with the advent of, of our company, we've had to slim down tremendously. So there's a lot of senior executives that have moved on, and there's a lot of executives that have moved on, and there's a lot of people that moved on, and there's been some technology developers that have moved on. And so that's what happens when you have austerity measures. At the end of the day, if you make $1 a week, you can't be spending $1.25 in perpetuity, right? It comes back to bite you. And we're at that inflection point where, as I said before, we've got to go from a cash burn to a cash positive, and that's what we're working towards. So part of the austerity measures, is to be the beneficiary of that change. You've seen our margins gross margins go from 28% to last quarter was 50%. And it would be really, really nice to see accelerated growth in our margins in the fourth quarter and increase that. I think that, third quarter will be pretty much the same as second quarter, but we're looking for some material change in as far as our gross margins in fourth quarter.
Yeah. So you get the insider lock, the insider blackout, it ends when the monetization is over, correct?
What ends?
The insiders can buy stock after that.
Oh, yeah. Well, listen, if you follow the rules and regulations of the of the exchanges. There's really maybe 10 days a year that you're open up where you can participate, because you're like, we're frozen right now because the third quarter, until the third quarter gets released, there's no trading. Between now and then, if there are any major actions going on behind the company, whether it's an acquisition, whether it's a divestiture, whether it's something material as far as change that could impact the stock price, then we're frozen. And so, last year, I had to pay almost $900,000 out of my own pocket in tax. That I had no chance of even selling any of my shares just to cover tax. And so, the burden is not just on just on our shareholders, but certainly the executive team and the people that have paid out their own money. I mean, I've paid now close to $5 million out of my own pocket in this business after tax money. And it really hurt, to have to be able to spend that. And basically, we were given a draw, meaning Albertelli and myself, against bonuses that we we're supposed to get. We ended up waiving those bonuses. And I ended up paying $1 million back on the draw that I have on money that I was already supposed to get. So let's put it this way. I wrote a check 4 months ago for close to $2 million to pay back the draw and to pay the tax on shares that I can't even, sell, even though, they were awarded to me. And so if I take a look at what I brought home after tax, I've actually, in the last 3 years, have worked for nothing. Literally nothing. Zero. Haven't been paid a penny, because the money that I had to borrow, to cover off the tax, and the draw, basically has not covered the income I have coming in from a payroll. So tell me how many people that can work 3 years for nothing. And so the bottom line is this, is that as much as it has been painful, you, the shareholders, and you are the most important, so don't get me wrong, I'm well aware that we wouldn't be where we are without you. The pain is not just yours, right? This has been extremely stressful and extremely burdensome, especially to me, but more me than probably anyone in the company, but especially to a lot of the senior executives. So, some of the senior executives all had to pay tax that they couldn't, move the stock. I mean, I don't think the shareholders mind you selling enough shares just to cover the tax. I mean, that's, that takes place with every company and every senior public executive team in a public company, on the planet Earth. We have been unable to do that. And so, like I said before, what I bring home hasn't covered off what I had to pay in the last year. So, so basically, as I said, for the last 3 years, I'm kind of net zero, minus zero. So it's been extremely stressful and extremely painful, and it's certainly not sustainable. So, but we believe in what we're doing. We are very mindful of the support that has been given to us by the shareholders. And I'm not complaining, but I'm telling you, I've been working 75 to 80 hours a week to make sure that I do everything I can to make sure that this company thrives and survives. And so we're doing that. I love our business. We have a lot of people interested in our business. We need to maximize our share value.
Yeah. I mean, regardless, the market would like it definitely if it would see like various people from the inside buying stock after.
Well, I mean, we can't. Like Eunice, we can't. But in essence, I wrote a check for $2 million 4 months ago. I don't know how much more I can do. Can you work for nothing?
No.
But that's what I've been doing, and that's the commitment I made to this company.
Yeah. But anyway, it's like when there's no lockout, the shareholders would definitely like to see like other people too.
I agree with you.
But
I
yeah,
agree with you. But you know
yeah,
that management currently owns over 30% of the company. It's not like management hasn't put their money where their mouth is. I mean, we
yeah,
we have, you know, a large investment in this company. And so,
yeah,
you know, if I don't know, you know, you can check to see what a typical, you know, management investment in the company, but I would say to you it would be 10% or less, you know, in typical companies. And I think that we stand out front and center as much or more than most. So
yeah, yeah,
we put lots of money into this company. As I say, I've got close to 5 million on my own. So
yeah,
yeah, it's, I don't know, it's a lot of money in my, you know, where I come from.
yeah. That's something a bit different. There was an article that some House members in the US they have introduced a bill that would require title insurance on GSE-backed loans. Do you have like it would mean like I guess no AOL. Do you have any thoughts about this? Like, have you
Well, I
seen
mean,
this?
anything that's going to bring more business to us, I mean, it makes me happy. But I think that, you know, the only way, if I want to be honest and realistic, the only way that we can be successful is by making home ownership more affordable. And so, hence, when I talked about our equity protect platform, where on average it may cost $4 a month for the homeowner, you know, once, you know, title is established, then I think that you know, also, you know, answers the bell. And so we think that we've, you know, kind of you know, almost hedged our position on all aspects of any change that will take place.
Yeah, I mean, from what I understand, this would mean you couldn't have AOL in title in GSE-backed loans.
No,
Is
no,
this
no,
still
that's not true.
the
That's
quote?
not true. Basically, the Federal Financing and Housing Authority, Fannie, Freddie, the GSEs have all endorsed our product. So AOL is going to take place. We have a different strategy of how we're going to roll out our AOL, and that'll be probably for the next interview that we have. I purposely avoided talking about it right now because we're going to enter into a whole different strategy and how we can blow that out, and we're really optimistic about it. So I'll talk about that, you know, next
Yeah,
interview process.
yeah. I mean, what I understand from this like bill, like it's a bill in the House, and if it would get like it would change things. But I don't know.
But
The
I think
article
that
wasn't very specific.
I
Yeah,
think
it was
I
something
think
we
you'll find out.
noticed.
Sorry, go ahead. My apologies.
Yeah, it was something that somebody posted on the forum, and people kind of got worried that if it goes through, it's because I think most of the mortgages are backed by the
Yeah.
GSEs or
So
like.
let me say this: best thing that ever happened to us. Best news that could ever happen for us.
How is that?
Because of
would be
what?
the
Because of technology that we built, and because of providing an opportunity to meet that requirement, falls right in our lap.
so the AOL would meet that requirement. Or, right.
Either AOL or a combination of AOL and something else.
All right, all right. So I don't know if do I have anything I haven't asked. What about this? Like I read another article that it says that MSR trade has been higher than last year,
Mm-hmm.
and the fourth quarter is going to be a big MSR quarter.
We're hoping
Like,
so. We're hoping so.
And how about this? Like you have all mentioned that it's hard to measure growth in this environment, right? Because of the transactions are going down. But could you somehow like like let's say in your appraisal business, like in the market share, you have gained market share, right? Like,
Yes.
can you somehow like put that into numbers?
We're
And
so small as far as what we offer right now. We're less than 1% of the total addressable market in AMCs. How we're going to change that is with our floor plan layout, our sketches, you know, and AVMs. We're also addressing it by doing appraisal direct. So essentially what we're trying to do is do more with less, you know, and so therefore have more competitive prices. So I think that's where you're going to see the material changes. The technology that we have introduced will start taking place in 2024 by the you know, the Freddies and the Fannies of the world, that they will start backing this new policy that they have approved, and quite frankly, with us working on more appraisal direct and focusing in on our technology, we'll be able to sell that to all of our you know, even competitors out there, because they're going to need to use that technology to be competitive.
yeah. And by the way, you got put into the Fanny appraisal list, or
Yes.
like that?
Yeah, we did.
Have you been on that list before, or is this like a new?
That's brand new. It's
All right.
it's an esteemed society to be able to be accepted into. I think there's only 6 or 7 in the country, and so you know, kudos and hats off to Al Broadway and his team for achieving that. And that and he could not have done that without, you know, the ANOW acquisition that we did. So, you know, quite thrilled, because that is integral as part of this new, you know, kind of appraisal service offering that'll take place in 2024 with the technology and the floor plans and the sketches.
All right. I think we are
Okay.
running out of time here.
Yeah.
Do you have any ending comments? Or...
Not really. I mean, we're working hard. We're trying to stay
Yeah.
contemporary. We're trying to stay ahead of the game. We're not, you know, we're not resting on any laurels at all. I mean, we're fighting for every inch that we get. We've, you know, reduced our workforce by, you know, over 40%. And, you know, basically we're sweeping the floors and washing the windows and cleaning the house all at the same time right now, because we're doing it with, you know, with every austerity measure that you can exist. And so we'll continue to do that. There'll be other changes that we'll announce in 2024 that I can't talk about today that I think are very positive. So we'll continue to just keep working as hard as we can, and just have faith. Honestly, we're working, we're going to get there.
All right. Well,
thank you very much.
Thank you for the interview. Yeah,
You're welcome. Yeah, thank you. Bye-bye now.
Yeah, bye.